Unit 5. Accounting recording of all economic categories. As we observed in the previous unit, economic categories in accounting are based on several basic concepts related to business activities of a company. Business activities are the main activities of the company that primarily generate revenues, the activities related to the production and sale of goods and services, with the exception of investment and financial activities. In this section, the issues of accounting recording of economic categories, which primarily refer to assets, liabilities and equity that are included in the income statement as one of the fundamental financial statements, are going to be explained. After reading this unit, you will be able to issues of accounting recording of economic categories. Learn more about long-term assets, short-term assets, liabilities and equity. In the accounting sense, the most important economic categories are the integral part of each accounting recording. Whether it is accounting for entrepreneurs, non-profit organizations, budget and budget users accounting, tradesmen and freelancers, economic categories such as assets, long-term and short-term assets, liabilities and capital are applicable in all accounting concepts. For entrepreneurs, it is especially important to observe double-sided economic categories: assets, liabilities, capital, income, expenses and operating results, that make up a basic feature of dual bookkeeping. Assets. To carry out its activities, an enterprise needs assets, which represent the resource that the company uses to carry out its business. According to its function and lifespan, assets are divided into a. Long-term, permanent assets. B. Short-term assets. Assets can be tangible and intangible and money. According to its function and lifespan, assets are divided into a. Long-term, permanent assets. B. Intangible assets and money. A. Long-term assets. Long-term assets consist of intangible assets, research and development expenditures, formation expenses, concessions, patents and licenses, trademarks, investments in other assets, goodwill, advances on intangible assets, etc. Tangible assets, land, forests, building facilities, plant and equipment, tangible assets in course of construction, etc. Financial assets, shares in affiliated companies, investments in long-term securities, current deposits, down payments, long-term loans, etc. Long-term receivables, from affiliated companies, from sale on long-term credit, etc. Long-term tangible assets. Plant and equipment are long-term assets acquired for use in business operations and are not intended to be further sold to customers. For example, land, buildings, machinery, furniture and inventory, office equipment and vehicles. A freight vehicle in the car salon is part of the inventory. When the same vehicle is sold to a furniture shop, in order to be used to deliver goods to customers, it becomes a unit of plant and equipment. Tangible assets are tangible physical assets, such as land, buildings or machines. This group can be divided into two different subgroups. A. Property subject to depreciation includes tangible fixed assets of a limited useful life such as buildings and office equipment. B. Land. The only tangible property that is not a subject to depreciation is land, as it has an unlimited useful life. Determination of procurement costs of plant and equipment. The costs of plant and equipment purchases include all legitimate and necessary expenditures for the acquisition of assets and their putting into operation. As the benefits of the machine ownership will flow into the company, for example for 10 years, all secondary costs incurred during the procurement and putting the machine into use will be included in the value of the machine. This is based on the accounting principle of aligning the income and expense. Since the machine will produce revenue for the next 10 years, the expenses must be allocated for the same period. For example, it may be expenses for transportation, transit insurance, installation, trial operation and other costs that are necessary for the asset to be ready for use. Capital expenditures and period costs. Expenditures for acquisitions or for the extensions of tangible assets are called capital expenditures and are recorded in assets accounts. Ordinary repairs, maintenance, fuel, and other items required for the use of plant and equipment are called period costs and are recorded in expense accounts. The reason for charging the expense account is based on the assumption that the benefits of the expenses will be fully realized in the current period, so that when determining the net profit, the expenditure should be deducted from the period revenue. Long-term intangible assets. Intangible assets are those assets that have no physical characteristics and are not tangible, and the enterprise will achieve the economic effects of its use over a period of 1 year. However, these assets may also be contained in a physical form, in the form of a contract and the like. According to the Accounting Act, the position of intangible assets comprises research and development expenditure, patents, licenses, concessions, trademarks and other similar rights, goodwill and advances on intangible assets. The basis for the recognition of intangible assets is found in IAS 38, on the basis of which a company should recognize the intangible asset at purchase cost only if it is probable that future economic benefits attributable to the asset will flow into the company and if the cost of the purchase of the asset can be determined reliably. The intangible asset should be systematically amortized with the best estimate of its useful life. R&D expenditures represent expenditure incurred for the research and development of new products and technologies whose results are expected to be used over a period of more than a year. These include investing in research and studies for acquiring innovation at the founding, expert services, appraisers, a meeting room for the founding assembly, and the like. Investments in patents, licenses, concessions, trademarks, franchises, investment in leased assets, and similar rights are a form of intangible assets that the company uses to earn its income over a period of more than a year. A patent is a right which protects the patent owner, inventor, in the economic exploitation of the invention. The patent can be recorded on the balance sheet under intangible assets only if it is acquired from others. Patents are recorded at the cost of the purchase plus all expenses directly attributable to its preparation for the intended use. A license is the purchase of a right, that is a permission to exploit someone's patented inventions, protected industrial traditions and the like, protected intangible assets. This purchase indicates the time right to use it or the right to produce a certain amount of a product. The license agreement is legally regulated by the Civil Obligations Act. A franchise is a right acquired when one company pays the other one a fee for a particular business. It usually includes a right to sell certain products or provide a franchise service by using a trademark or service mark, organization and the technology of sales or delivering the service. Well-known examples of a franchise are Taxi Cameo, Fondy and others in the fast food industry, fashion brands. Usually, the fee is paid in advance for multiple periods or more financial years, and therefore the franchise is characterized as long-term intangible assets. A concession is a contractual defined permission whereby one party gives another party goods or rights to the economic use and the other party pays a fee for using the rights. The condition for the acquired concession to be considered a long-term asset is that the fee has been agreed for several years and that it has been paid in advance. If the concession is paid in the period on the basis of a comparative achieving of economic benefits, then it is the expense of the period. The examples of concessions are concessions of local self-government units and cities, state concessions. Investments in rights also include bought intellectual property rights, copyright and publishing rights, customer lists, trademark, know-how, market shares etc. The purchase cost also includes a paid tax that cannot be deducted. Investing in borrowed assets in order to bring the rented facility into a condition adequate for carrying out the activity. Investments can also be made on the basis of a lease agreement of a real estate or movable property. When contracting a business premise lease, it is often necessary to make an investment in the subject of the lease so that the leased premise is brought into a condition suitable for use. Often this investment can be done by the lessor, and then the lessee does not recognize such investment on his balance sheet. A goodwill signifies a higher value of a company that it has thanks to its reputation and similar factors that cannot be measured or it can be difficult to measure them and which result in a higher value of the enterprise. This value is reflected in the positive difference between the values of the enterprise as a whole in comparison to the sum of the value of its individual parts. On the balance sheet, a goodwill is recognized only if it has arisen in the process of acquiring and merging of another company. In accordance with IAS 38, an internally generated goodwill does not meet the recognition criteria as an asset and cannot be recognized as intangible assets on the balance sheet of the company, since it is not a resource that can be identified and controlled by a company and the cost of its acquisition cannot be determined reliably. IAS 38, Group of Authors, 2016. Advances on intangible investments are amounts of advances paid to the supplier on the basis of a contract. Long-term financial assets. Long-term financial assets are investments for the purpose of achieving future economic benefits in the form of interest, gains or certain indirect benefits. Investment returns are expected within a period of more than 1 year. Long-term financial assets consist of investments in long-term securities, shares, bonds, treasury bills, etc. Long-term deposits and down payments. Shares in affiliated companies. Share in the capital of another company, etc. Given long-term loans. Long-term receivables. Receivables are property-related relationships created on the basis of a credible document between the creditor and the debtor, and thus the receivables for the creditor mean a right to charge, and for the debtor an obligation to pay or return the received goods, etc. 13. Group of Authors, 2004. B. Short-term assets. Current assets are types of assets that are expected to be converted into money in a very short time or in a business cycle, most often within a year, therefore those are relatively liquid assets. Current assets include money, investing in marketable securities and inventories. Inventories and receivables from customers are classified as current assets, even when the conversion of those assets into money will not be completed within 1 year, but for the classification of such assets as current, a business cycle that may be longer than a year is used. Current assets appear in the form of things, rights and money, all three basic forms. The balance sheet of current assets includes inventories, short-term receivables from customers, affiliated companies, employees, government. Short-term financial assets, received short-term securities, checks, bills of exchange, etc., short-term loans, deposits and down payments, shares in affiliated companies, etc. Money and money equivalents, cash, foreign exchange funds, foreign currency, etc. Prepayments and deferred expenses, prepaid expenses and accrued income. Short-term receivables. Short-term receivables are those receivables that are expected to be realized within a short period of time, up to 1 year. The most common short-term receivables are receivables from customers, government receivables and the like. They are particularly interesting in case of problems with the entrepreneur's obligations settling, since this is a balance sheet item for which money inflow is expected. Money. Money, as the most liquid asset, is part of the company's short-term assets, and is recorded in bank accounts, giro accounts, open letters of credit with the domestic bank, cash registers, foreign currency accounts, open foreign currency letters of credit and foreign exchange cash registers. Short-term financial assets. Short-term financial assets are cash placements for a period shorter than 1 year. The recognition and measurement of short-term financial assets are regulated by FDI 9, Financial Assets, and IAS 39, Recognition and Measurement Financial Instruments. Short-term financial assets include short-term loans given to other entrepreneurs, purchased securities, given deposits, and other short-term debt securities and the like. See liabilities. Liabilities are companies' debts. In order to be successful, the company must borrow money to replace the funds invested by the owner, thereby allowing further development of the enterprise. The borrowed money is used to purchase new and more efficient machines, which results in more efficient production at lower costs. The one who lent the money to the company becomes a creditor while the company is obliged to repay the money. Liabilities towards creditors take precedence over the requirements of the owner. The total assets available to the entrepreneur may originate from two sources. A. From creditors, other sources of property, so-called liabilities. B. From the enterprise owner, own sources of assets on the balance sheet are referred to as capital or equity. On the balance sheet, obligations are part of the liabilities and represent other sources of the assets of the enterprise. According to IAS, a liability is defined as the current corporate liability deriving from past events, which is expected to result in the outflow of resources containing economic benefits. The decision on the publication of Croatian Financial Reporting Standards, HSFI 13 NN, Zagreb 3008. Based on maturity, liabilities are divided into a. Short-term, current liabilities, liabilities that are expected to be settled within 1 year, counting from the balance sheet date. B. Long-term liabilities, liabilities with a repayment term of more than 1 year counting from the balance sheet date. Characteristics of liabilities. Liabilities are defined as debts or obligations that have arisen from transactions or events in the past and require settlement in the future. Therefore, the company is now making a commitment to give up the resources in the future. Differences between debts and equity. Enterprises can be financed from two sources, borrowed or their own. In case they are funded from the borrowed capital, then debts or obligations to return the funds are created. On the other hand, enterprises can be financed from their own resources, and that is called the equity. The main difference between them is that the receivables of the creditor mature, which means that they need to be paid on the date called the maturity date, and the equity is not due. Furthermore, liabilities have priority over the equity in the case of enterprise liquidation. However, the creditors do not thereby have the right to control the business of the enterprise. The liabilities for issued short-term securities, such as checks and bills of exchange, which have been given to the creditors in order to settle a particular obligation, or the intention is, by issuing securities, to collect funds from their buyers, for example commercial bills. Accrued liabilities arise when expenditures for which payments will be made in subsequent periods are recognized. Examples of accrued liabilities include liabilities for interests, tax liabilities and wage liabilities. Advances received. When a future buyer grants funds to a GIRO account of an entrepreneur regarding a future delivery of goods or services, a liability for the recipient of an advance is created, to make a delivery or to return the money. After the delivery of goods or services has been made, the entrepreneur submits to the buyer a regular delivery invoice, rectifies the previously calculated VAT on the advance, and for the accepted advance credits the buyer. Long-term liabilities are liabilities with a maturity of more than 1 year. Such liabilities are usually the result of purchases of long-term assets, the purchase of another company, or the refinancing of an existing long-term liability which is about to mature. Unlike long-term, short-term liabilities are liabilities with a maturity of less than 1 year, and they are a result of regular business transactions. Liabilities for loans, deposits, etc., which are received in the country and from abroad, from citizens or other companies. Liabilities to banks and other financial institutions, from banks, insurance companies, etc. Long-term provisions for risks and charges are current liabilities for future expenses. They are a source of finance related to the revenue burden of the current result for expected future costs that will result from current sales and the income of the accounting period. If provisions would not be recorded, incomes of the future periods would be charged and the result of the current business would be presented unrealistically. Provisions are determined on the basis of estimates or on the experience in cost estimates. IAS 37, Group of Authors, 2016. A deferred payment of the costs and the income of the future period. These positions are also referred to as accruals and deferred income. For the purpose of a fair presentation of financial results, it is necessary to allocate more realistically the paid costs and revenues of the future period. D. Capital. Capital is the equity or own resources of a company's assets. The capital shows the value of the assets, money, things or rights, that the owners have invested in their company. In the case of a joint stock company, the capital is expressed as share capital, and when it comes to a limited liability company, LLC, it is expressed as subscribed capital. Own capital represents a permanent source of the company's assets. It is recorded on the liability balance sheet and constitutes a permanent source of own assets that are recorded on the balance sheet assets. The value of own capital is equal to the net book value of the company, namely, net book value equals total assets, liabilities. Capital equals assets, liabilities. Capital is always in connection with the owners of a company, founders, investors, shareholders. Capital is a counterbalance to assets on the balance sheet. From the formula, we can see that the equity in the liability statement shows how much of net worth belongs to the owners of the company. Regardless of whether it is a joint stock company or a limited liability company, the capital includes invested, paid, equity directly brought by the owners, and earned capital. In literature, capital is often referred to as equity, net assets, own capital or capital and reserves. capital consists of a subscribed founding capital, share premium, capital gain, or a capital loss, revaluation reserves, statutory reserves, legal reserves, reserves for own shares, other reserves, a retained gain or capital gain and loss carry forward or a loss for the current year. Bestvit, v. 2006. Capital can be invested in several forms. Money, by paying into a giro account of the company. Things, by bringing the plant, equipment, inventories, etc. into the company. Rights, by introducing a patent, license or other rights into the company. Earned equity is the result of business activities of entrepreneurs. It represents a gain after taxation. We talk about the difference between profit and expense after the profit tax has been paid. If the earned profit of the current year after taxation is not paid to the owners but is retained in the company, then, on the basis of the decision of the company's management, it is transferred to the retained profit or is redistributed to retained profit and reserves. Own capital structure. Based on the balance sheet, the components of own capital are: subscribed capital, premiums for the issued shares, capital gain, revaluation reserves, reserves, statutory, legal, other, retained earnings, loss carried forward, gain, loss for the current year, after taxation. The company's own capital can be increased in several ways. Through new members that bring new founding capital into the company, by recapitalization or by increasing the share of founding capital by existing members of the company. With new share issue, JSC. By a capital gain, JSC. A decrease in a capital occurs when a loss for the current year has been realized. A gain for the current year or the retained earnings for the previous years has been paid to owners or when the dividends are paid to the shareholders. A share has been paid out from the founding capital to the investor who exits from the company. The diminished value of the previously revalued long-term assets has been compensated from the revaluation reserves. Profit and loss account. The profit and loss account is a report showing the business performance of a company. That is, it shows the total profit and loss of the business and their difference as a gain, in case of positive business operating, or a loss in the case of a negative business operating. The basic structure and contents of the profit and loss account are defined by the Accounting Act and are composed of F. Revenue recognition. Revenues represent one of the most important elements of the financial statements on the basis of which the business performance, methods of revenue recognition and measurement in the financial statements are estimated, as defined by the Accounting Standards, SEVA, 2013. As regulated by IAS 18 revenue, the recognition of revenue is based on the basic accounting assumption of the occurrence of an event, on the basis of which revenues and expenses are recognized at the time they were incurred, and not at the time of the actual money receipt or expenditure. Revenue is earned when the main condition of the agreement between the two parties is fulfilled, that is, revenue is recognized when it is probable that future economic benefits will flow into the enterprise and when those benefits can be measured reliably. Therefore, regarding the recognition of revenue, the principle of caution is very important, requiring that the revenue is recognized only when it is certain, while expenditures are recognized even when they are possible. Expenditure recognition. As defined by IAS 1T, 7, expenditures are one of the 5 elements of the financial report and, together with the revenue, are directly related to the measuring of the financial performance. Expenditures can be recognized in the profit statement if the reduction of future economic benefits results in a decrease in assets or in the increase of liabilities that can be measured reliably. This means that the recognition of expenditures occurs at the same time as the recognition of the increase in liabilities or reduction of assets. Statement of comprehensive income. According to the International Financial Reporting Standards, IFRS, entrepreneurs, that is large enterprises as well as those entrepreneurs whose shares or debt securities are listed or are being prepared for their listing on an organized securities market, are obliged to draw up a comprehensive income report, http://national-novine.nn.hr. The aforementioned report is, in fact, a supplement to the income statement and includes income and expense items that are not recognized as a gain or loss, but through the capital, that is, comprehensive gains. The comprehensive income statement contains the following elements. Given that the basic economic categories contain the financial information important to the investor but also to the corporate entities which are doing business with the company, it is the obligation to publish annual financial reports. Everyone has the right to insight into the publicly available annual financial reports of companies that are obliged to publish them and which are available on the Croatian Financial Agency website. The Accounting Act defines two groups of obliged entities. 1. Entities obliged to submit an annual financial report for public announcement. 2. Entities obliged to submit an annual financial report for statistical and other purposes. Entities obliged to submit an annual financial report for the purposes of public disclosure are entrepreneurs, that is companies and individual traders, a business unit of an enterprise established in another member state or in a third country if there is no obligation under the laws of that state to keep books and to draw up financial reports, and a business unit of an enterprise from a member state or from a third state which is a taxpayer in accordance with the regulations governing taxes. This group also includes subsidiaries of foreign enterprises in the Republic of Croatia, if it is not a business unit as defined by the regulations governing companies. Entities obliged to submit an annual financial report for statistical and other purposes are the above-mentioned entrepreneurs and legal and natural persons, taxpayers, entrepreneurs, craftsmen, freelancers. Economic categories accounting is primarily linked to cost accounting, that is internal accounting, which mainly provides information to internal users and which monitors and studies internal processes in the enterprise, that is the processes of transforming inputs into the business outputs. However, accounting monitors all business processes in the enterprise. As we know, it targets certain accountancy information users. In accordance with the above, today, accounting is divided into a financial accounting, cost accounting, and managerial accounting. Crovaca, Adini, 2009.